Let's be honest, the thought of an HMRC audit can be pretty stressful, right? For anyone who's self-employed or a landlord, it's a real worry. But what if you could just sidestep all of that stress? Well, today, we're doing just that. In this briefing, which we've developed with the brilliant experts over at My Tax Accountant, we are going to pull back the curtain on the top blunders that could put you right in HMRC's crosshairs in 2026. So let's dive in. So here's a question for you. Could one tiny, simple mistake on your tax return really end up costing you thousands of pounds? You've worked so hard, you feel like you've done everything by the book, but could one little oversight unravel everything? Well, I'm afraid the answer is a resounding yes. And honestly, with the big changes on the horizon for 2026, that risk has never, ever been higher.
Okay, look at this number, 27 million pounds. That's how much money HMRC clawed back in just a single, small pilot campaign. And get this, they weren't chasing after some complex, high-level fraud. Nope, they were just focusing on one of the most common mistakes people make, incorrectly claiming personal expenses as business costs. Because that pilot was so successful, you can bet they're now rolling this out on a massive scale. So, to make sure you're fully protected, here's what we've got on the agenda today. First, we'll look at HMRC's brand new audit triggers for 2026. Then, we'll cover the classic mistakes that now come with some hefty new penalties. We'll dive deep into the Great Expense Crackdown, get you ready for making tax digital, touch on the challenges of modern money, like crypto, and most importantly, we'll show you exactly how to keep yourself safe through all of it. Right, so what is it about 2026 that makes it such a critical year for getting your taxes right? Well, the short answer is that the entire landscape has changed, and HMRC now has a very powerful new mandate to find every single error.
And here's where it all stems from. Fresh out of the 2025 budget, the government is putting immense pressure on HMRC to close what they call the tax gap. That's basically the difference between the tax that's supposed to be paid and what they actually managed to collect. To do this, they've handed HMRC a war chest of, wait for it, £2.6 billion purely to invest in compliance. This isn't just business as usual, it's a supercharged mission to hunt down errors and undeclared tax.
So how exactly are they doing it? Well, meet Connect. You can think of it as HMRC's very own supercomputer. It is a phenomenally powerful tool that creates this complete 360-degree view of your financial life. It pulls in data from everywhere, your bank, your credit cards, the land registry, even your letting agent, and it cross-references everything. It makes spotting any discrepancies between what you're earning and what you're declaring incredibly simple. Basically, there's nowhere left to hide.
Now, this new level of scrutiny is especially dangerous when you think about those classic, common mistakes people have been making for years. The big difference now is that these simple errors can have really severe consequences that can literally follow you around for decades.
All right, these are the big ones, the tripwires. Missing that 31st of January deadline? That's an instant £100 penalty, no questions asked. But the one that really catches people out is failing to declare all of their income. Picture this, you're a freelance graphic designer in London, you pick up a small weekend project, get paid in cash, well, that has to be declared. Same goes for any rental income or money you've earned overseas. Every single pound counts.
And this is where it gets really serious. The stakes for getting it wrong are incredibly high. If it's a genuine mistake, an honest error, HMRC can look back at the last 4 years of your accounts. But if they decide it was carelessness, that window suddenly extends to 6 years. And for deliberate evasion, they can dig into the last 20 years of your financial life. Just think about that. A simple error you make today could be causing you a massive headache in the year 2046. Okay, now let's zoom in on the area where HMRC is focusing all this new firepower, the Great Expense Crackdown. This is where that $27 million was recovered, and it all boils down to one simple but crucial question. Was that expense truly for your business?
If there is one thing you take away today, let it be this. It's the wholly and exclusively rule. An expense is only tax deductible if it was for the sole purpose of your business. Here's the simple way to think about it. If there's any personal benefit at all, and you can't clearly separate and account for it, the entire claim could be thrown out. It is a very, very strict test.
Let's make this crystal clear with some real-world examples, because this is where people get confused. Driving to meet a client? That's allowable business mileage. But your daily commute to your usual office or workshop? That's considered personal, so it's not allowable. Claiming a portion of your home electricity bill because you have a dedicated office space? Yes, that's fine. Claiming your entire weekly grocery shop because you sometimes eat lunch at your desk? Absolutely not. It's this gray area that is an absolute minefield.
And here's a quick pro tip for you straight from the team at My Tax Accountant. Try to avoid using round numbers when you claim expenses. You see, claiming a neat £500 for office supplies just looks like a guess to an inspector. But claiming £487.55, that shows you're working from actual receipts and keeping meticulous records. It's a tiny detail, but it sends a powerful signal that you're diligent and organized.
Okay, stay with me on this next one because it is a huge deal that's going to affect almost everyone. We're talking about making tax digital, or MTD. And I want to be clear, this isn't some optional upgrade. It's a fundamental non-negotiable shift in how you report your finances to HMRC.
This timeline lays it all out. Starting from April 2026, if you're a sole trader or landlord and your annual income is over £50,000, you must comply with MTD. Then, just a year later, in April 2027, that threshold drops down to £30,000. So as you can see, the clock is well and truly ticking, and getting prepared now is absolutely essential.
So what does this actually mean you have to do? Well, it really boils down to 4 new obligations. First, say goodbye to the shoebox full of receipts. All your records have to be digital. Second, you'll need to use software that can speak directly to HMRC's systems. Third, and this is a big change, you'll be sending summary updates every quarter, not just once a year. And finally, you'll wrap it all up with a final declaration. It's a complete overhaul of the old system.
That's not all. Here's where so many people can go wrong in our modern economy. For years, cryptocurrency felt a bit like the Wild West, didn't it? But trust me, HMRC has caught up, and they are now actively targeting undeclared profits from crypto. A lot of people have this dangerous assumption that crypto isn't taxed. Big mistake. If you sell a crypto asset and make a profit, you are liable for capital gains tax. That's 18% if you're a basic rate taxpayer and 24% for higher rate taxpayers. And if you're earning crypto through things like mining or staking, that's treated as income, which means it can be taxed at up to 45%.
And the consequences of getting this wrong are, well, they're severe. This isn't just a friendly reminder from HMRC. It's a serious warning. Penalties can be as high as 200% of the tax you owe. And in the most serious cases of deliberate evasion, it can lead to a criminal prosecution and even prison time. They are not playing around with this. Okay, I know we've covered a lot of risks, and it can all feel a bit overwhelming. But now, let's get to the most important part, the solutions. It's time to shift our mindset from being reactive and worried to being proactive and feeling secure.
Here it is, your checklist for a truly bulletproof tax return. Start using MTD-ready software right now. Get ahead of the curve. Keep digital copies of absolutely everything for at least 6 years. A separate business bank account is non-negotiable. It just makes tracking everything infinitely easier. Be meticulous when you're apportioning those shared costs. And the golden rule, if you are ever in doubt about anything, don't just take a guess. Get proper professional advice. Because look, while following all these best practices is absolutely essential, the ultimate protection, the real peace of mind, comes from expert guidance. A great accountant doesn't just fill in the boxes on a form. They make sure you are claiming every single legitimate deduction you're entitled to, which maximizes your return while making sure you are always compliant and safe from any investigation. So, if you want to navigate all of these changes with total confidence, the experts at My Tax Accountant who helped develop this briefing are ready to help. They specialize in self-assessment and can guide you through everything we've talked about today. You can give them a call on 0208-570-8531 or just drop an email to info@mytaxaccountant.co.uk. And finally, just a quick and important disclaimer. The information we've shared here today is for general guidance. It really shouldn't be relied upon exclusively when you're making financial decisions. For advice that's tailored to your specific circumstances, you really must consult a qualified professional, like the fantastic team over at My Tax Accountant. Thanks for your time.